everyone. I was having Java problems. I'll be right back. I'm going to tell the rest of the class that I finally got on here. Hang on just a second. I appreciate it. Okay, everybody. I hope you can still hear me. Yep. Yep. All right. Well, thanks, Teresa. You were actually a big help on your emails. I appreciate that. And really hard to read everything on the screen with the updated Java, but I think I can figure it out. Okay. I'm hoping everybody can see my PowerPoint and everything. Thank you, thank you. Okay, we're going to talk about stocks and their valuation. Pretty interesting topic for tonight. So we'll talk about that. I will tell you tonight I'm coming to you from Midtown Manhattan. I am going to be speaking for the next couple of days at investor conferences where they have these people that invest in stocks, and they come and listen to companies make a presentation for, I don't know, 30 or 45 minutes, and then you go into individual rooms and investors come and meet with you one-on-one, because even in a public company setting, the investors like to meet with the management as much as they can. So many investors being concentrated in New York, and particularly in the Midtown part of Manhattan. That's where I am. And so, you know, a couple of things. We've got some practice spreadsheets on stocks and dog sharing. There's nothing required there. You don't have to do it. Not sure anything related to that would be on a quiz or an exam, but it would help you to spend some time on it. We'll have a quiz this week, some light math. It won't be anything hard. For those of you who have requested and been given permission to have makeup work, I will post that within the next week. And we're getting close to the end. So I think in general the class is doing extremely well, and I'm really happy with how everybody's doing. So we'll just keep moving ahead. Now, I want to talk about common stock, and I've used these words before, but it is common. It means it's held in common with others, and it's plain old common stock. It doesn't have any preferences or anything special about it. But when you own the stock, it means you own the company, which means you imply control. And as we talked about before, the owners of the company elect the directors of the company, and the directors of the company select the people who are going to run it. So the directors themselves are the representatives of the shareholders, who then elect people who are going to run the business, people like me. It's not uncommon, but it's not always common to have someone like me who's both in the management and on the board. It does happen, but it's in the bigger company that may or may not be the case. Management's goal is to make the company worth more. And that is represented in the stock price. So we're trying to make it worth more. Call me crazy. The other thing is that stock means you have a perpetual right to that ownership, because in a corporation you own that as long as the entity survives. It survives your life, and you can pass it on to others. So it's a pretty interesting concept that once you own a piece of that company, you own it forever. Until that company winds up and goes out of business. And if for some reason it did sell or wind down its affairs, whatever's left over after you pay everything off would go to the common shareholders. But the other side of it is you get the unlimited upside. So that's why people like to own stocks as opposed to other forms of investment, because the returns are greater. You make more money. So that's why people want to own stocks, right? Now, what affects the value of a stock? Well, I would tell you it's how much money do you make, what assets do you have, what prospects do you have, what does the market perceive. But clearly some other the things that may not be as intuitive to you as that, as you know, if you're making a ton of money, the stock would be worth more. If you're sitting on tons of assets, the stock would be worth more, obviously. But investors like stable. They like it to be really predictable. And they want to be able to quantify. And I would tell you, I know it's not something you would ever think of, but when people start looking and investing in your stock in a big way, so a fund is putting in, $10 million, $20 million into your business, they will build a financial model. They'll build an Excel model in your business to try and understand it. And so one of the biggest forms of communication in investing in stocks is really Excel models. It's crazy, but that's really how it works. But back to my deck here, people want stability. And so if you think back to the discussion from last week of beta, when I said beta was really, really important, beta is a measure of volatility. And people, if the world was perfect, they would get a really, really stable, predictable stock that grew in price dramatically. Typically doesn't go together. So there are things that can happen that would cause instability, proxy fights, meaning different shareholders trying to take over control of the election of the directors. So people who are activists or dissenters or don't like the direction that management has taken the company and want to replace them with others. There are people that will come in and will try and buy a business that the business doesn't want to sell to them. Maybe Coca-Cola wants to buy Pepsi and Pepsi doesn't want to sell to them. And so it becomes a hostile takeover. And then there are things people can do called poison pills, which means that they will put provisions in their documents that will make it extremely unlikely that people would want to undertake a hostile takeover, because when they do that, certain things would happen, would cause things to break up and reduce the value of what someone would be trying to buy, to try and keep the things as stable as possible. The other thing that people typically don't like is dilution. That's your, I guess, a proxy and a hostile takeover and a poison pill and volatility are all finance words of the week too. But dilution is probably a much more commonly used word in finance. And I think I've said it to you before, if you had a glass of Dr. Pepper and you poured a bunch of water in there, you would have diluted Dr. Pepper. It just wouldn't be the same, right? And so what most investors don't like is that if you own a piece of that company, they don't want more money coming in that would cause them to have less ownership of the business. Now, if you bring in cash, in theory, that cash is equivalent to the amount of the dilution, so no one is really hurt, but no one really thinks of it that way. They like to think about how much of the percentage of the business do I own. So in many cases, many shareholders, particularly those that have some sort of preference or came in first or were in a big equity raise, they will get preemptive rights. And that this means that when you own this stock, a lot of times you have some rights that are attached to it or are pertinent to it. And in this case, preemptive, all that really means is that if you're going to raise new money for the business, people have the right to buy as much of that issuance of new shares so as to keep their percentage ownership the same. There's lots of other of these rights that happen. There are registration rights, which means that they would have the right to register their shares for sale on a stock exchange. They would have piggyback rights. So if you would sell and they would have the right to piggyback along to sell. There's a drag along right where the company would, if they're selling, would have the right to drag along some of your shares to sell. So, but the big one that you would need to know that really relates to dilution is this notion of preemptive rights. So people would have the right to put as much money in the business to keep their percentages as possible. And all the other anti-dilution provisions that I talked about. You don't really need to know those, but you need to know about dilution, the possibility of dilution when new money comes in, and why many investors may or may not find that to be positive. Excuse me. slide 6. All right, there are multiple types of stock. Obviously, you've got the, preferred stock, you've got common stock. But when I'm talking about common stock, sometimes you have A shares or B shares, and they have slightly different rights. Some may be able to vote for the election of directors. Some may have non-voting shares. There are many times the people that started the company have something called founder shares, and they maybe have some really super anti-dilution provisions in there so that they really don't get squeezed out. And one thing to remember, in C Corp, only a C Corp can have multiple classes of stock. If you're in an S Corporation, you can only have one type of stock. Most people forget about that. So C Corps, you can do all these fancy things where you can have founder shares and voting and non-voting and A shares and B shares. Another finance word of the week, number 6, I suppose, is this notion of earn-out stock, which means if you do certain things, once you, let's say you become public and you have, or you sell your business. That's probably a better example. You sell your business and you say, hey, look, I know I'm making $100,000 a year, but I think I can turn this business into $150,000 a year business. Okay, great. If you do, you can earn some more stock in the company. So it's called earn-out. And in a transaction, when a company is acquired, many times there is an earn-out component. It may be earn-out stock or earn-out cash or whatever, but their earn-out stock is pretty common. Also, there's some other factors that affect the stock values. Growth versus dividend. Now, if you have a growth stock, which means that we think the stock price will continue to go up, that attracts one type of investor. I just heard on the news the other day that General Electric, one of the country's largest, industrial producers, is going to cut their dividend, which they pay out to their investors. Well, who likes dividends? In terms of individuals as opposed to institutions, who likes dividends typically are retired people or people planning to retire because it's money they use to live on. Now the stock could go up and they could make more money, so they've got some upside, but they're also getting paid along the way. So though the appetites for those different types of things would change the appetite for an individual stock and therefore the value of that stock, because obviously the more people want that stock, the more valuable it is, and the fewer number of people that want that stock, the less valuable it is. And so, I know that sounds simple, but many people don't seem to think of it in those terms. And so, are you a growth stock? Are you a dividend stock? Or, are you a large cap? Or you a small cap? The size of the stock matters on values, right? And so, if you were doing the same thing with the same profitability profile, what's more valuable, Walmart or my company? Well, Walmart. Right? It's just because it's Walmart. Also, there are certain industries that will be in favor or disfavor, regardless of the profitability or the assets or the management of the company. So, for example, and there have been a couple of booms in my lifetime where high tech became unbelievably in favor, and those values ran up dramatically, all to have the balloon burst on them. But so many times a certain industry will be in vogue, and there will also be those that are not: tobacco, alcohol, firearms. While I'm at it, so there may be the election of different administrations will affect the valuations of firearms manufacturers. It may sound counterintuitive, but when the Obama administration was in place, people were, they thought that there would be more demand for guns, and so, arms manufacturers did well, where in the Trump administration, there's less of a rush to go buy guns, and so there's less valuation. Governmental policy, I would tell you, in my business, the government is requiring this new regulation that would require all truck drivers to keep track of their driving hours by electronic means. It's an automatic electronic log, and that changes the valuation of businesses. It does. People would ask me constantly, are you already electronic logging compliant in advance of the regulation? Yes. Therefore, they check a box, they think I'm worth more than the next guy. If the government was to pass, if the federal government was to pass this major infrastructure bill, and we were going to build a lot of roads and bridges and tunnels, and they would do lots of big trucks to move a lot of big stuff, my company's valuation would go up. So governmental policy will absolutely affect stocks. If they came out and said that the government came out and said we are going to, like they did in New York City where I am, where the mayor came out and put on some restrictions on sugary drinks, that could affect your stock price, whether it's up or down. Market conditions overall, sometimes people start wars in another part of the world, sometimes there's recessions in other countries, sometimes, so there's just the general market conditions, the general economic factors, both macro and micro, will affect the stock price. What's going on in your individual industry would matter, and so there are so many different industries to be in, but if people are not spending money on technology, but they are spending money on new homes, so that might not be general market conditions, but certain sectors of the economy would affect it. And that really goes down to market appetite. Sometimes people are interested in buying stuff, and sometimes they're not. Transparency is a interesting word. The notion for public companies is they are very transparent and open to everybody. And the transparency means that people have more access to see your financial statements. You have to give all these disclosures. People can read all about it, and therefore they know more about you. It's funny for my company because of the need to be able to tell everybody the same thing at the same time. With an incredibly high level of certainty as to the accuracy of the information, is actually tended in many cases to reduce the transparency of our company, because to be more transparent would have violated the rules. Interesting, huh? And then this notion of required return is how much people do they think they have to make to be involved in the market at today's rates. So once again, the idea is these analysts and investors are out there trying to figure out what your stock is worth. What is it really worth? And so if you go back to that notion from the first lecture, and I'm going to go to that slide here in a minute, trying to tie some things back together, that you're trying to assume that the stock price equals its actual value. If the stock price is lower than its actual value, then it's undervalued, and you probably want to buy it. If the stock is trading at a valuation that's higher than what you think its real, honest to goodness value is, then it's overvalued, and you probably don't want to buy it. Or if you own it, you probably want to sell it. Right? And so those are some things that you ought to think about. Back to the same chart we used at the beginning of the semester, which is, here's what happens. All of those things we just talked about above that can affect a stock price. All those things are up here: political climate, taxes, managerial actions, economic environment, and all of those, what's that, and all those other things we talked about would relate to what the real cash flows are going to be, what the real risk of the business is, and that means that's what the company's real value is. However, the outside world, and many times the management of the company itself, don't know what that is, and therefore there are the perceived cash flows to investors and the perceived risk to the business, and those add up to the stock price, and that's what you're trying to figure out. It's what's the difference between the stock price and the real value. And sometimes, even if you know what the real value is, do you think the stock market will react to that and make the stock price eventually become the real, honest to goodness, actual intrinsic value? None of which is assured. So how do you try and estimate the intrinsic value of a stock? Well, how do you make money in a stock? Well, one, you get paid dividends. That's pretty interesting, right? So they're going to pay me a dividend. So they're going to pay me a part of the profits that come out of this business every quarter, semi-annually or annual. Or capital gains. That means I buy low and sell high, right? How many times have you heard that in your life? Buy low and sell high. It's like a house. You know, you want to buy a house for $200,000 and you want to sell it for $300,000. It's the same for a stock, and the difference between the 200 and the 300 is $100,000 is your capital gain. So how are you going to make money? You're going to make money by getting paid a dividend, or you're going to make money by the stock price going up. Or if you're a super savvy investor, you may make money by betting that the price of a stock will go down, and it does go down. And I've alluded to it before in the course, but that's called short, or shorting the stock, or a short position. And so in my stock, we currently would monitor, as any other public company would do, to see what the short position in your stock is, because that's how many people out there are betting that your stock is going to go down as opposed to go up. And so you can actually sell high and buy low. If you have a good broker, know what you're doing, you can short a stock. And so those are the 4 basic ways you make money. Now the capital gains are really the buy low, sell high, and the sell high, buy low are really subsets of capital gains. That's how you get to a capital gain. So that's how you make money. But how do you try and estimate the value? Well, you can use the discounted dividend model, which is kind of like a net present value calculation. Or you can use the corporate valuation method. The most common that you would see would be the price to earnings ratio, which means if you take the earnings per share and what the price per share is, that's a multiple of the earnings. So it could be, if you're making $1.50 per share in earnings and you had a 10 PE, that means the price of a stock would be $15. $1.50 times 10 equals 15, right? That's how you get to the price to earnings, and then the enterprise value approach. But all of those are ways that people use to try and figure out what a public company stock is worth. This would do that, and when they do this, when they focus here on this one thing, they are going to take that number and compare it to something. Remember when I kept talking about you could have benchmarks or comparisons or comps, and this is what they're talking about, because the price to earnings ratio by itself means nothing unless you compare it to something else. So everybody's trying to figure out what the comp is. So what's the comp to Walmart? Well, it's probably Target. Well, okay, what's the comp to Target? Is it Kohl's? Is it Marshall's? What is it? What's the comp? So people are trying to figure out what the comp is so they can figure out what the appropriate price to earnings multiple would be. So when I talked about the analyst, they build the model to try and figure out what the earnings are going to be of the company, right? And then they go to comps to figure out what they think the multiple should be to get to what they think the price should be. And this is why it's probably the one that's the most easily understood, the most commonly used, the quickest to try and figure out what the price of a stock should be. And then once again, the discounted dividend model is really just a NPV type calculation of the future dividends of the stock. So let's talk about it for a minute. This is the book's way of doing it, and I think it's pretty good. So if you got a dividend each period, and you got some money, you could add up and figure out what you think that the stock is worth, right? So you take the dividend yield plus the capital gains yield equals the total return. So how much money, you paid $30.29 for the stock, you're getting paid a dividend of $2.12 per share, therefore you got a 7% dividend yield. Now you paid $30.29 for the stock, you sold it for $32.10 per share, and therefore you have a gain of, what is that, $1.90 or so, and that gives you a 6% yield, and so the dividend yield plus the capital gains yield equals 13%. That's how you figured out what your return was during the first year. But this calc right here doesn't really take into calculation or into consideration. That's the word I was looking for, consideration. It doesn't take into consideration the time at which these happen. So you want to get that dividend every year, and then you would need to think about when the capital gains would actually be realized when you sold it, and then do an NPV back, right? All right. And now what happens if you got less? Well, you know, you just can't use a constant growth model. You'll have to use a variable cash flow model, and it would look something like this in this term. So you got a different type of return each month, each year that you owned it, because the dividend had a non-constant growth to it, right? So let's talk about it and see what that looks like. So you figure out what the dividend is for the first year, and the capital gains for the first year, and then after the year 3 that had constant growth, it would have been 7 and 6, but here it's the same thing, I guess, right? 13%. And varying cash flows to get to the same net result. That's what that example was supposed to do for you. If a stock was expected to have a negative dividend growth, so if they were paying $1 a share one year and they were going to pay 90 cents the next year and 80 cents a year, the next year, would anybody still buy the stock? Well, yeah, because it still has value. It's still producing cash flows. It's just not producing as much. The free cash flow method suggests, and the corporate valuation, but it's really good, suggests the value of the firm is the value of its free cash flows. For a company like mine, people use this thinking all the time. So what is the company's cash production from its operations, less its investment in capital expenditures, essentially? And then what is the present value of that stream of free cash flows? And people will be looking at our company on an EBITDA basis as opposed to an EPS basis, or a free cash flow basis on a regular basis. I said basis about 47 times in that one sentence. I need some sort of reward for that. So, you know, how do you apply this? Well, you're trying to determine what the market value of the firm is. You're trying to figure out what the free cash flow is going to be. And then once you do that, you subtract the obligations of the company, meaning that's debt or preferred stock. And then you divide that by the number of shares, and you figure out what the stock price is, right? So I think sometimes the books makes this a little complicated, so I try and make it really simple. Is just what's the value of the enterprise, of the entire company. If you said its free cash flows are this, therefore it's worth that, but I also have to pay off the debt, therefore what's my net, and that is the quote-unquote equity value. Hey, there's your finance word of the week, number 20. All right, so people like this over opposed to the dividend model, and particularly when it comes to pay dividends like mine. So we don't pay a dividend, so people need to look at our valuation differently, which is why they like to point to free cash flow on a regular basis as a reason. Now, the thing is, it says many of these models will assume that the free cash flow is going to grow at a constant rate. Well, that's nuts. Cash flow doesn't grow at a constant rate. Cash flow ebbs and flows. And so you need to not for this course, but in the real world, you have to think about variable cash flows over a period of time. So once again, same kind of model thinking, and you come here and say, what's the intrinsic value per share? We've got 40 million in debt and preferred stock, and there's 10 million shares of the stock. So the market value of the company equals the market value of the company minus what it owes. So if the market value of the discounted cash flow analysis of the free cash flows of the business, that's a mouthful, ended up to be 416, let's call this $417 million, but you had 40 million of debt, the net equity value, the real intrinsic value of the business is 378 million. Now, how do I turn that into a price per share? I come in and I say the market value of the entity is 378 million, or what I'm going to call the equity value, a term that we use, that I hear used more than market value, is equity value, divided by the number of shares. So if we had a market value of $377 million, but we had 10 million shares, then the value per share is the true intrinsic value of a share is 37.69. I don't know why that math doesn't look right, but I get it. 37.69, and I would compare that back to the price of the stock, which we had earlier in the deck, which was I was going to pay $30.29 for it. So that's a good deal. It's undervalued. It sounds like a good buy, something I should consider buying based upon trying to estimate the free cash flows generated by this business. Now, once again, this is used all the time. All the time, all the time, all the time, all the time. And most stock analysts will look at our business on a multiple EBITDA basis. For more mature companies that have been around longer, people are certainly going to look at the price to earnings ratio. That's the most common. Other people will use other metrics to kind of validate where they are to the comps to the other stocks that are closely similar to this business. So they would also run a price to cash flow, price to sales, and other ratios, and they would run a price to EBITDA, trying to figure out what the value of this business is. But once again, remember, it is almost always based on comparable firms, and this multiple method is the #1 starting point to figure out what someone thinks the value of a company is. Now, the enterprise value approach is just the value is greater if the company returns more than the cost of its equity. And that's all this is trying to say. And I don't see the enterprise value approach very often. I'm not going to ask you to calc it, but I'm going to ask you to know what it is so you can respond to it in a quiz. And once again, I'm going to reiterate, we've been talking about common stock, but there's also preferred stock out there, which is a hybrid security that's kind of halfway in between debt and equity. And so it would get paid some sort of a preference. Usually you get paid some dividend per quarter. And then after that, once they get paid that, they have the right to participate in everything that a common stock position would have. And so it's debt-like features, but keeps the upside. So it's a highly advantageous position to be in. Okay, and we have a quiz. Have a great week. If you have any questions, contact me, email me, and I'm going to change that right here now. I'm so hard to get by phone. Yeah. Email me, and also copy Bo on it so that we can respond to you as quickly as possible. Do we have any questions? It should be open now. Let me take a look real fast. It should be open. But you're right, it's not showing. Okay, I will work on that, but I think you can see right here, it's supposed to be open now. But I can see that it is not. Okay, let me, I'll figure it out and how's that? Better? All right, it should show now, Teresa. Anything else? Okay, thanks everybody. And if you have any questions or anything, let me know. Don't forget, if you want to be doing something productive, start reviewing for a big, long, comprehensive comprehensive final exam, number one, and number two, go to asimplemodel.com and start noodling around on that website. Read your book, Final Exams Open Book. That's the best way to get the foundation for a great grade on your final, is to have a good facility for what the book says and then what I talked about in the lectures. But once again, a lot of the questions will be around what's in the book. Okay? Thanks a lot, everybody. Talk to you soon.